I'll introduce the panel. So we have Alison Wong-Gates from Semper Barons. We've got Rashmi Gopinath, who's former GP from P Capital and N12. We've got my friends Victoria Dragar from Felicis and Kathy Gao from Sunfire. All right. So I'll kick off with the topic du jour, which is AI and investing. Right. I'll give a little bit of a preamble in terms of how ADP is thinking about it. Right. So we've been around for about 75 years, 65,000 associates, million clients. Very, very core HR focused, very, very payroll focused. So when you think about a ton of processes, when you think about a ton of transactions that happen along those lines, I think for us, the question is like, how do you make all of this more efficient for our clients? How do you make it more efficient for our employees? And so things like agents working within the ecosystem, and things like co-pilots, helping practitioners. This is sort of the first topic, but then you start thinking about things that are a little bit more transformative. So I'd love to hear Dan's perspective on what you're seeing and what you care about as far as this topic goes. So I'll start with you, Dan.
Sure. Thanks for having me. Just as a preamble, in case people don't know who Sapphire Ventures is, we are a venture capital firm mostly focused on the mid to late stage. We are B2B focused, both horizontally and vertically. I spend a lot of my personal time around the future of work and everything HR tech related. So it's such a pleasure to be here and hopefully can meet a bunch of you in the audience. So AI, we've been fairly active in AI this year. The last 3 deals we've done this year have all been AI deals. But as growth stage investors, the little trick is, right, there's a lot of AI companies right now that are growing extremely fast. I was just having a conversation in the audience beforehand. But the question is, how much of that is durable? How much of that is sustainable? There's a lot of experimental AI budgets right now, large corporations who have basically been given carte blanche by the CEOs and by the board members to say, hey, you've got to go try and do something with AI. And so as investors, it's kind of our job to kind of parse apart what is actually durable and tangible versus maybe a flash in the pan. But there are a couple of areas, especially as it pertains to the future of work, that I'm personally very, very excited about. The first one is highly relevant to the ADP. Right? Think about ADP, it's a core system of record. It's kind of like the core database where all this important, very rich, very valuable information lives within an enterprise. Generative AI, think about some of the innovation around this technology. Like, it's really how a user can interface with software, right? You don't have to write code. You don't have to do drag and drop. You don't have to do low code, no code. You can simply chat with a solution.
That's right.
Right? And if you think about layering that type of technology on top of a core rich database like ADP, I think it really opens the TAM and it opens a limitless opportunity in terms of how to use that data, both in terms of employee interaction, but also other data across enterprise, right? I'll give you guys one specific example. We're investors in a company called Glean, some of you guys might be familiar with. It's essentially an AI-powered enterprise search tool, right? But it needs data, right? And a lot of that data sits within ADP. So we're starting to see these really interesting dynamics between systems of record and systems of engagement. And so that's the area I'm spending more time on. I'll save the other ones, I let others chime in.
Okay, I love that topic. Well, I'll give you first 30 seconds. It's great to be here. I've had the privilege of partnering with ADP and several of our portfolio companies. And so we'll talk about that later. Felicis is early stage B2B, and AI is a critical investment focus area. One of the places Felicis has invested quite a bit into the infrastructure layer of AI with companies like Weights and Biases. And then I encourage you all to check out this post that we did. It's on the Felicis blog around the agentic AI. And the way that we think about it is really focusing on labor. We're taking on horizontal and vertical AI, where are the biggest pools of labor and how will AI impact that labor? And some of it is skilled and some of it is unskilled. And in skilled, we invested in this incredible company called Poolside, which is transforming the experience for developers on the engineering side, and then less skilled. There are some fantastic companies in customer service, companies like Sierra, which are growing very, very quickly. And so you literally can just go through, marketing, sales. Sales has had unbelievable growth in terms of AI innovation, and really look at labor and the number of employees in that particular function and compare that to the opportunities. In terms of ADP and incumbents versus startups, to me, the opportunity for incumbents with AI is massive because of two points. The first is the big system of record companies fundamentally are about processes. They're about managing and automating massive processes. That's what Workday and ServiceNow and ADP does. And that is what AI is suited for. But to also do it well, you need access to data for training. And again, the incumbents have that data. And so we think you're actually super well positioned to partner with, invest in, do some of it in-house as you think about next gen and how you're going to implement AI.
Great.
Yeah, I think on AI, I mean, for folks that have been investing in a while, this is not a new space that many of us are investing in. We've gone through a few cycles of what AI innovation has looked like. But I think what's different in the Gen AI world is just the rate of acceleration of innovation that has gone through and how accessible AI for the first time has been, where anybody can now play around with AI. You don't need to have sophisticated degrees to be able to build your own version of an agent or your own version of a model. And it becomes, I think that accessibility piece makes it really powerful. Because in the past, again, you needed like a massive horde of like PhDs and scientists to be able to make this tool available. And that's something we think about a lot from an investment standpoint is, for the first time, the incumbents or the large companies aren't going to be hindered because of the lack of innovation. Everybody now, it's become a level playing field where you all now have access to the infrastructure and the tools to be able to play around and incorporate AI as part of the product and the offering. One of the things that we also pay close attention to is in that innovation ecosystem, what are the large tech incumbents doing and where might there be gaps for startups to build very compelling solutions? And if we take like even an example of CRM, where we've seen recent cases of like Klarna and other companies switching out of Salesforce and using their own homegrown CRM to be able to adapt for what that new user experience for CRM looks like. And I think that's something that ADP and I'm sure other incumbents are thinking about in a very deep way is how do you stop yourself from just being that system of record or that database which now can be replaced very easily. And the core focus is now on the user experience and how do you enrich that user experience because of the personalization, the customization that AI can bring into that workflow. And that workflow can be across sales, it can be across coding, it can be across product, it can be finance teams. I think the opportunity again is limitless in terms of where the innovation from AI is going to touch. But I think it's a great opportunity for incumbents again to capitalize on all the data assets and the data moat that they have, but be quick to react, because if you're not quick to react, there's a high risk of somebody else coming in and taking that spot.
Mm-hmm.
Hi everyone, I'm Allison Baum-Gates from Sempervirens. I'll give you a quick background on Sempervirens and then I'll answer your question, but I also want to quickly poll the audience. How many of you are startup founders? Okay, how many of you are investors?
Right.
Okay, and how many of you focus on partnerships?
Yep.
Okay, awesome. So that's helpful, thank you. That's always useful to know how to tailor my answers. Sempervirens, we're an early stage fund. We focus on companies that are transforming the relationship between employers and employees. So in the US, most individuals get their job from their employer, they get their healthcare from their employer, and they get their money from their employer. So we're investing in technology that's transforming that relationship in some way. I've been focused on the future of work before that became a ubiquitous term, and I think what's very cool to see is that with AI, basically every company is impacting the employer-employee relationship. So we think about it really more broadly from the organizational level. We run a community of 150 senior HR leaders at publicly traded companies, including the CHRO of UPS, the CHRO of Electronic Arts, the CHRO of Albertsons companies, so across all sectors. And I think what we've heard from them is that with AI in its current form, they're having to take a step back and actually completely reimagine what their workforce looks like. So we're thinking about it more at the jobs to be done, individual worker perspective. And what we've been spending a lot of time on is how the enterprise is making decisions about that, how they're actually, who within the C-suite is partnering to rethink what does my workforce look like between AI and between individuals, and then, how do those two intertwine? And then how does that intersect with consumer employee behavior, right? I mean, for the most part, employers will do what will only make big changes when employees force them or their customers force them to do that. And so we're spending a lot of time kind of trying to pay attention to what does the adoption curve look like at the individual employee level? How do you get people bought into using AI when it might actually obviate their role altogether? And so we've been thinking a lot about that, investing in companies, especially AI enhancing revenue driving roles where it's very clear that the individual is compensated on being more productive, and the enterprise also is very successful when they can accelerate some of those movements. So thinking about where do incentives align between employers and employees when it comes to adopting AI tools.
So is it fair to, maybe we'll make our way back from you, Allison. Is it fair to say when you look at a potential investment and a company, you mentioned jobs to be done, right? Do you think about all the factors that we mentioned, like what does the tech stack look like? What is the defensive moat from that particular tech stack? How are they leveraging AI as opposed to, hey, you built a new engine to do X? And so I guess there's some degree of future-proofness that you're looking for.
Mm-hmm.
And you think about, pricing models. Like, would you consider that companies need to start charging for outcomes as opposed to per seat, which is what we're used to in our industry quite a bit? I think this is an interesting topic that's come up through some of our thinking. So curious to hear your thoughts.
Yeah, I think there's two different pieces there, and I think both tie back to this concept that Kathy brought up around durability.
Yep.
Everybody's really excited about trying new things, but how is it going to look over time? And we go through these cycles, right, where there's kind of point solution explosion and then consolidation, toward end-to-end solutions. And we had kind of point solution explosion during COVID, where everybody had budget to try new things, and they found something that could do the job way better. And so it was very much product-driven growth, very much I want the best-in-class solution for every job that has to be done within my organization. And then the economic reality sat in, and it turns out that you want to do every job to the best of your ability, but turns out sometimes something is just good enough, and that's fine. Because it's not necessarily mission critical. And so then it kind of swung back in the other direction. And as we've moved more toward that kind of consolidated end-to-end solution, I think the way that startups have gotten the attention of customers is by moving toward utilization or usage-based pricing. And that's been a way to kind of get a foot in the door. But turns out that's pretty difficult too. And so I think while that may have help them get some really exciting logos, there's, especially when you're dealing with an employer-employee relationship, there's a lot of guardrails around engaging with the end user and getting them to actually use it. And so that hasn't flown through to actual revenue. So it's really about kind of knowing that those cycles are going to continue to go. I think we're now on the upswing where all of a sudden with agents, everybody's looking for best in class, and there's an opportunity to break in not necessarily top down, but go straight to the user and get them to use a tool and kind of have that more bottoms up sales process. And that's great if you can get your early traction that way, but the question is, how do you position yourself to make sure that as the tides shift, so can you, and you can adapt through your partnerships, your business models, whatever it may be. So that's my 2 cents.
Yeah, this is such a fun topic. On the pricing, I actually think there's so many debates. The SaaS debt, right? How many times have you all heard that question? I don't think we're going to debate it here, but I would say that SaaS pricing, the pricing is dead. I think we are going to move away from per user, per seat pricing. The 2 biggest changes that I see, and I see it happening already with portfolio companies, is adding pricing, as Allison was talking about, that is based on, or adding, not necessarily completely eliminating, that is based on consumption. So example would be one of our companies, Dovetail, which is an insights platform, customer insights platform. In addition to the core product of the customer insights repository, you can also set up channels to track different insights around your customers. Maybe you want to see Jira tickets. Maybe you want to know the difference between your enterprise customers versus your SMB. Each one of those is a channel, and we're already charging a consumption-based price based on the number of data points that you're consuming per year. So that is here, and Notion is doing it, Dovetail. And then the other big one is I do think per outcome pricing is also going to transform certain industries. Most obvious would be sales and customer support. In sales, as a former CRO, I know how much, what companies pay for SDRs, and, with all your benefits weighted in, it's expensive. It's, 60 to 70K per SDR. Companies like 11X, and 11X has competitors, are coming in and really transforming SDRs. And so instead of paying per seat of a sales software of 1,000 per seat, you can potentially charge somewhere, if the outcomes are really fantastic, somewhere up to that level. Of course, it's not going to be 60K, but if you actually can manage your team so that the SDRs that you do have are doing the really value add work, and the automation is in place to produce results, that is outcome-based pricing. So I do see that coming. What do you guys think?
There's another reason why we're seeing more usage-based pricing or consumption-based pricing with these AI companies. It's also their cost structure.
Right.
They're in COGS,
Yeah.
it's the inference cost, and if you sell someone a per seat license, they end up using the tool so
Yeah.
much, you can quickly become
It's so true.
gross margin negative
Yeah.
on that customer. So I think that's another reason. But I'm going to say something that maybe is a little bit spicy. I don't know. I honestly think that from a product differentiation perspective, it's going to be a really, really tough place, right? So oftentimes people talk about, we're going to evaluate these different companies and products and which one is the best. I'm not sure that's the best way in the long term to win, right? I'll bring one other dimension up, and I'd love to hear from others. I'm seeing success winning in other channels. So for example, there are companies that are really focused. Everyone says they have the best product, but the ones that have really sprinted forward in the outer ways are the ones that have gotten distribution back.
Sure.
100% agree. Distribution is the new moat in AI.
So-
Yes, and we're not saying this because of ADP. Really, we really think it is.
I think
Yeah.
the next panel would be an interesting, coverage
Okay.
of distribution, but actually, probably worth talking about incumbents to some degree, also from the perspective of strategics, right? So when we hear things like that Klarna announcement, I heard two of you say incumbents have an advantage. Then there's another camp that says, "Oh crap! if that actually works, do you still have that defensive mode, or does large enterprise start to do software very, very differently?" So I'd love your perspective a little bit on that.
Yeah,
on that
absolutely.
little-
I think, again, having the data moat is a huge advantage, but again, it is going to be time bound
Right.
to a certain period. And I guess the question then comes back to what is the end user experience and how is that going to continue to transform? If you think of Salesforce, and anybody's here from Salesforce, apologies. The product, unfortunately, the user experience hasn't changed much. It's been 20 years, and the expectation still is that an AE is going to go in at the end of the day and put in like all their notes and all the meetings. It doesn't capture data at that point where it needs to be captured. It doesn't bring in the rest of the experiences. As you think of like the broader sales ecosystem, you've got companies like Clari, and you've got companies like Sixth Sense and Gong and others that are all enriching that go-to-market experience, which unfortunately, if you think of Salesforce, it is a database at the end of the day. And that database can be easily replaced by something else. So I think the question for incumbents, and I'm ex-Microsoft, so I'm going to say good things about Microsoft here, but I do think that Microsoft played it really well with the Copilot apps that they've launched and the integration that they have with OpenAI, and trying to weave in AI into everything from Teams to Office products and everything else, with that intent of how do I change or adapt to the expectation of what the user experience is going to be, and trying to stay ahead of the hundreds of startups that are also trying to figure out what's the next Excel killer and what's the next PowerPoint killer, and how do I bring in AI into creating a deck that automatically like brings in the content of what I want to create and create that beautiful interface without me having to spend hours in putting that PowerPoint together. But now like you can do that with PPT as well. So I think the opportunity for the incumbents is to really think through how is that user experience going to be disrupted, and how do I take advantage of that data moat to stay ahead of that?
I'm going to switch gears a little bit. Thank you for that insight. It's definitely agree with speed to defend the moat, which is distribution and data, right? You think about 40 million people that we know, and we'll talk about scale earlier. I think that gives us some degree of headway in terms of the core asset, but evolving and changing is obviously top of mind, and that's why we're venture investing. So I'll tee the next topic up with regards to what ADP Ventures does. So we are a strategic investing arm. We're very thesis based. We'd like to partner with the companies that we invest in. But when you lead with that conversation, the first response is not always, "Oh, happy to talk to you." There's some founders that say, "Maybe I don't want to work with this strategic." And so that's what I'd love to pivot the conversation to, and get this panel's perspective. And don't throw tomatoes, but tell us what you feel about strategic investors and CVCs and working with them. Maybe Kathy, we'll start with you.
So no, no.
We're at the very early stage, right? So I meet a lot of founders that are really afraid of strategic investors. And I think that I understand why. But the reality is also that strategic venture arms sit within a very large organization. I had a conversation with somebody who's at a strategic venture arm, which shall not be named, and they said, yes, we're strategic, but we just don't know what our strategy is. And so I think there's you have to look at it as an incredible opportunity to partner on the distribution side, and know that these are very large organizations, and it's very highly unlikely that of the thousands of companies that you meet every year, you're gonna be like, hey, I heard this good idea, and I'm gonna call our CEO and tell them that we should do it. It just doesn't work that way. So I think we've seen through our portfolio a lot of really incredible transformational partnerships when you're able to effectively navigate a partnership with a strategic venture arm. And that means knowing what questions to ask. How does this tie in with commercial connections? And is there an opportunity to have a commercial partnership before we do an investment? Or how does that work? And how do you make sure to back channel with other founders who have also worked with this strategic arm and, you know, see if they've delivered the value that they've promised. But if so, we've seen it, when done right, work extremely well. Because what venture investors want to see is that you have the opportunity for hockey stick growth. And you can go out there and you can sell one by one by one by one. But how are you going to take your ACVs from 20K to 40K to 50 million, which is what one of our portfolio companies did through a distribution partnership with a strategic venture. It was a commercial and an investment opportunity. So I think that's the power of you know, what you can make happen, but it takes a lot of work. And there's no reason to be afraid. I think you just have to look at it as an incredible opportunity.
Yeah, I have spent more time on the corporate VC side than on the institutional side. So started my investing career with Intel Capital, and then Microsoft Ventures, and then B Capital. So I would say that with the corporate VC, it's like you approach an institutional VC. I think understanding the reasons of why the corporate VC is interested in investing and what are going to be the strategic value or impact points that you can get from it, as well as does the team have the ability to navigate the organization? Do they have the platform team in place that'll help the portfolio companies in getting the right value from the startups is an interesting aspect to dissect. And again, the rationale of why that corporate VC was set up in the first place is so helpful to understand. When you think of ones like Cisco Ventures or Salesforce Ventures, which are a great way for M&A into the broader company, for Microsoft Ventures, it was set up to help drive more agile consumption within the enterprises or SMB customers. And so figuring out a way that your application software can be co-sold along with Microsoft, if there's a way to get there, I mean, that creates like a great win-win opportunity, both for the corporate VC as well as for the startup. So understanding like the intent for why that was set up, and does the team have the ability to help you navigate and get you to the outcome? Maybe you're not looking for that co-sell, maybe you want to get acquired. And so who's that right strategic partner that you need to bring in to help make that happen is what like we would recommend startups to think about.
On this point, I think it is such a critical point, strategic partnerships and distribution. I would say, as a former operator and now on the investing side, only about 10%, if that, of these partnerships actually go somewhere in terms of delivering revenue, like in real meaningful revenue, transformative revenue. But if they do, they can make the company. So I'll talk for a minute about Naya, which has partnered with ADP, but also with other carriers, with MetLife, with Workday. And to make these partnerships work, it is super heavy lifting, and it is done over multiple years. It doesn't happen overnight. You really need somebody, you need CEO and others on the team to actually be 100% committed to this, to understand, to your point, why it is strategic to that corporate venture arm. And if the fit is there, you can make it work. I would urge you to ask a lot of questions about that to make sure that it's not sort of like a sidelined in the corner somewhere of the company, but that it's actually core to where that company is going. And the TLDR on our company Naya is that it formed a partnership with ADP first as a customer commercial partnership in 2022. Then in 2023-24, Oz got involved, and the venture arm invested in Naya, and through that investment, they were a critical partner in helping to navigate other parts of ADP, including launching with the PEO business. ADP has the largest PEO business in the world. So just those two alone, and we're not even talking about the rest of ADP, but just those two alone are over 1 million lives. And so through ADP, Naya now reaches about 15% of covered lives, and across all distribution partnerships, which include carriers, Workday, MetLife, it's over 40%. So it's almost half of the company. And so if you get all of these pieces of the formula right, it can be massively transformative.
The only other last point I'll quickly make is choosing to go with a strategic investor can also be a defensive move. What I mean by that is if you are in a market where there's another player that you're watching very closely, you guys are very competitive, say in the HR space, and your competitor, instead of you, gets an investment from AGP Ventures or Workday Ventures, whoever it might be, that might box you out. So there's a little bit of strategy you have to think through.
Well, we're very friendly with Workday Ventures, so they're also in NIA.
Yes, they are also in that.
I promise I didn't ask Victoria to say anything nice about us, so thank you for
No,
that.
I said everyone across all streets. Just NIA decided to go this route, and it's 40% of total of their total end customers. Just a huge number.
Well, thank you for your insights and thank you for being part of the panel. Thank you.
Okay.